Did you know that if you invest $100,000 at a growth rate of 4% per year, in 30 years, you'll have $324. But if you learn how to invest your own money the right way, you can grow your money by 8 to 10% per year. And in this case, you would have $1.7 million. That's a $1.4 million difference. And so that's why in this video, I'm going to share my exact investing strategy that I use myself and to help hundreds of clients so that you can get an 8 to 10% rate of return on less than 1 hour per month. Hey, if you're new here, my name is Michael Lee Kim, and I'm a financial coach, CPA, TEDx speaker, and digital nomad. And my goal is to help you learn how to retire young, not old, all while enjoying life. Let's get into it. The first investing strategy that I use is honestly really simple, but the thing is, most people get it wrong. One of my clients was investing his money for retirement with his financial advisor. And after 5 to 10 years, he honestly wasn't seeing much growth. And so when we took a look at his portfolio, he realized that he was in a low risk and balanced stock investment portfolio. And this is why his investments wasn't growing, because if you're in a low risk or balanced stock investment portfolio, you can only get about a 4 to 5% return per year. But if you're in a high risk, high growth stock investment portfolio, you can get up to an 8 to 10% rate of return per year. And so this is a common mistake that I see people make, which is not having the right asset allocation for your stock investment portfolio. There is a time and a place for a low risk and balanced stock investment portfolio. For example, if you're already in retirement and you're living off of your investments, you probably want more of a balanced or low risk stock investment portfolio. Because if there's a stock market crash, you don't want all of your money to drop down in value. But if you're far away from your financial goal, either 10, 20, 30 plus years, this is where you want a high risk stock investment portfolio. Because even if the stock market crashes tomorrow, you don't need that money for many, many years. And so you can just wait until the stock market recovers, which the average recession typically lasts about 1 to 2 years. And so this will allow your money to grow a lot faster because it's in a high risk, high growth stock investment portfolio. And this is why you want to allocate your money based on your time horizon to your financial goal. If you're close to your financial goal, you should have an asset allocation of about 0-100 to 20-80. If you have a medium term goal, your asset allocation should be a balanced type of portfolio, about 50-50. And if your goal is 10 plus years away, you should have a high risk, high growth stock investment portfolio. Now, keep in mind your asset allocation should be when you need the money. For example, when you're in retirement, you're not going to need all of that money right away. You're going to be withdrawing some and then leaving some money in investment. And so in this case, the money that you're going to be withdrawing earlier needs to be in a lower risk stock investment portfolio, while the investments that you're going to withdraw later can be in a higher risk stock investment portfolio. This will allow you to reduce your risk for your short-term goals, but still allow your investments to grow for your more longer-term goals. And this is why you need a tailor-made stock investment portfolio and strategy for each of your financial goals. For example, typically it's better to withdraw from your non-registered or RSP during retirement first and then leave your TFSA for last. And so in this case, you can have your non-registered and RSP in more safer investments, while in your TFSA, it could be in a higher growth portfolio. If you want to learn how to build your own stock investment portfolio so that you can retire young, not old, all while enjoying life, then get access to my free early retirement calculator. I'll leave a link to it in the description below. The second investing strategy that I use is really common knowledge, but most people do it wrong. You see, over the past 60 years, US investments have increased by an average of 10 to 15%. Meanwhile, Canadian investments have only increased by 8 to 9%. And so it's clear that US investments typically have a 2 to 4% higher growth rate than Canadian investments. And that's the reason why I invest most of my money in the US market. Now, I feel like most people know this, but the thing is, most people don't do it the right way. And so here are 3 common mistakes that I see people make when investing in the US as a Canadian. The first mistake is not taking into consideration withholding tax. As a Canadian, you have to pay a 15% withholding tax on any dividends received by a US company. So if you receive a $1,000 dividend from Apple, you would have to pay 15% on that. But there is an exception. Within the RSP, you don't have to pay any withholding tax. And so that's the reason why if you plan to have a high dividend stock investment portfolio that's based in the US, the best place to have that is within your RSP. And in your non-registered or TFSA, it's better to have more growth stocks that don't really give out much of a dividend. The second mistake when investing in the US is investing in the US with Canadian dollars. You see, there are ETFs that you can buy in Canadian dollars that track the US stock market. For example, the ETF VFV.TO tracks the S&P 500, but you buy it in Canadian dollars. Now, although this is very convenient for Canadians, The MER, or management expense ratio, of the ETF is typically higher than its US counterpart. For example, VFV has a MER of about 0.09%, while its counterpart, VOO, has a management expense ratio of 0.03%. Now, this is definitely a lot lower than any mutual fund management fees, which have an average rate of 2.5%, but this is still something to take into consideration. And so that's actually why I prefer to convert my money from Canadian dollars to USD first, and then buy the US version of the ETF. Now, the problem is that a lot of people do this, but they end up paying a lot of money in currency conversion fees, which is the third mistake. And that's the reason why I'm excited to share the sponsor of this video. Moomoo is an online investment broker with over 27 million global users, and they won multiple awards as one of the best brokers in the world. And I specifically like Moomoo for its extremely low currency conversion fees. To exchange money from Canadian dollars to USD, using Moomoo, you only have to pay a flat fee of $2 plus 0.09% currency conversion fee. And if you compare this with other brokers like Wealthsimple, RBC, or TD, this is a big difference. For example, let's say you're trying to convert $100,000 from Canadian dollars to USD. With Moomoo, you'll only be paying $92. While with Wealthsimple, RBC, or TD, you'll be paying about $1,500. And so you're essentially saving $1,400 right away. With Moomoo, you can also hold money in USD within your TFSA or RSP, which means you only have to pay a one-time currency conversion fee instead of having to convert your money each time you want to buy or sell a stock. Now, there are some platforms like Questrade where you can convert your money using a strategy called Norbert's Gambit. And with this strategy, you only have to pay a flat fee of about $10. But the thing is, in order to implement the strategy, you have to buy the ETF, journal your shares, wait 3 to 4 business days, and then sell your shares again. And so it's a bit of a tedious process. When the markets are volatile and changing really quickly, a lot can happen in 3 to 4 business days. And that's the reason why I like using Moomoo, because its currency conversion fees are really low, and you can convert your money instantly. And right now, Moomoo has some really great sign-up bonuses where you can get up to $300 when you deposit just $5,000 or more, and with over $2,000 in commission rebates. And so to sign up and get these bonuses and save a lot of money on your currency conversion fees, then feel free to use my referral link in the description below. And so if you're able to invest your own money in the US, which has a higher growth rate than Canadian investments, while reducing your withholding fees and currency conversion fees, this is how you can optimize your investment or growth. Now, the last investing strategy that I use is probably the most important, but often the most overlooked. You see, there are 3 main ways to make money through investing. There are capital gains, dividends, and interest, and each of them are taxed a completely different way. And a common mistake that a lot of Canadians make is not fully understanding how their investment income is taxed and how to use this information to pay less taxes and keep more of their money. But luckily for you, I'm going to show you exactly how these 3 types of income are taxed and how you should use this information so that you can pay less taxes. The first way to make money through investing is through capital gains. Capital gains is when you buy stock at a low price, but then sell it at a high price. For example, let's say you buy Apple at $100 per share, and then you sell it for $200 per share. You would make a profit of $100 per share. Now, only 50% of the capital gain is going to be taxed. So in this case, you would add only $50 to your taxable income. And assuming you have about a 40% tax rate, you would only be paying $20 in taxes. Now, the key thing about capital gains is that you only trigger taxes when you sell your stocks. And so that means you actually have control as to when you decide to pay taxes on your investment. And so that's the reason why if your money is in a non-registered account and you're in a high tax bracket, I would recommend not selling your stocks and only selling your stocks when you're in a low tax bracket. That way you can trigger taxes and pay taxes when you're in a lower tax bracket. The second type of investment income are dividends. Dividends are essentially cash distributed by a company to shareholders. And dividends are taxed in 3 main steps. The first step is the 138% gross up. And so let's say you receive a $10,000 dividend. You would gross it up by 138% and add the total amount to your taxable income. Now, although this looks bad, don't worry, it gets better. The next step is that you'll pay taxes on the gross up amount. And so let's assume your tax rate is 40%. You would pay total taxes of about $5,200. And the last step is a dividend tax credit. A tax credit is essentially a refund that you get after paying taxes. And there's a federal and provincial dividend tax credit. And so in this case, assuming you're based in Ontario, this is the total dividend refund that you would get, which means you'd only have to pay about $2,000 on the $10,000 dividend that you received, which means your average tax rate is only about 20%. And so dividends are actually very tax efficient, where you can make up to $70,000 in eligible dividends completely tax-free. Now, if you want to learn more about this, I created a whole video explaining about how this works. And so feel free to watch this video here. I'll leave a link to it in the description below. But the thing is, unlike capital gains, with dividends, you have to pay taxes when you receive them. And typically you receive the dividend on a quarterly or annual basis. And so that's the reason why if you're already in a high tax bracket, you should keep any stocks that generate a lot of dividends in your RSP or your TFSA so that you can defer or not pay any taxes on your dividends. The third type of investment income is interest. Interest is any income received by bonds, GICs, or a high interest savings account. And the taxes on interest is very simple. 100% of your interest is going to be taxed. And so if you make $10,000 in interest, 100% of that would be added to your taxable income. So if your tax rate is 40%, you would pay a total of $4,000 on this amount. And so similarly to dividends, interest is taxed once you receive it. And so that's the reason why if you're in a high tax bracket, you want to keep anything that generates interest in a registered account, either in a TFSA or RSP. That being said, investments that generate interest income are typically not growing very fast. And so that's the reason why you should remember the first step, to remember to only have low risk investments if you're close to your financial goal, and have more stocks if you're far away from your financial goals. And so this is essentially my investing strategy on how I'm able to get about an 8 to 10% return per year, which is by number one, having a tailor-made stock investment portfolio for each of my financial goals. Number two, optimizing my investments for growth by investing in the US while reducing my withholding fees and currency conversion fees. And lastly, maximizing my returns from my investments by reducing the tax on my investment income. And as you can see, there are many little details when it comes to investing that you probably weren't aware of. But these little details are the difference between the people who are able to retire early versus those who aren't. And so if you want to learn how to invest your own money so that you can retire young, not old, all while enjoying life, then apply to work with me in my coaching program, the Early Retirement Fast Lane. To learn more and apply to work with me, feel free to check out the link in the description below. Now, if you watch until the end of this video, you're probably someone who wants to learn about how to implement this investing strategy. And so I created a full investing playlist to teach you exactly how to do this. So watch it right over here.